All right, my name is Andrew Kuhn, FocusCompounding.com, Focus Compounding Capital Management, Focus Compounding Podcast. Sitting next to Geoff Gannon. Jeff, say hello to the camera.
Hello, camera.
Hello, camera. So in today's Instagram video, we are going to be going over infinite returns on capital. Jeff gets asked this all the time when we talk about companies. A lot of companies we look at, because they're service businesses, they all generate a ton of free cash flow. A lot of them are capital light. They have infinite returns on capital. So let's talk about what that actually means. Maybe go through the math behind it and try to help individuals understand this topic.
Okay, so this is definitely the topic I get the most emails about,
Yeah.
even though we've covered some stuff about it, return on capital in general.
Yeah.
People ask what kinds of calculations we do and all that. So generally what I'm talking about is the return on the actual amount of invested net tangible assets, so net of liabilities that I take out because I'm saying that someone else is funding them.
Okay.
Basically, a business wants to use other people's money. It does not want to use its own money. You don't want to use shareholder money. Financial leverage, you get a bank to lend to you instead. That's how, LBOs and things work. What you want is, for us looking at stock, it's usually customers funding it. It can be other people too.
So like, for example, like a bank, if you think about a bank,
Yep.
a bank has customer deposits. So you keep your money at the bank can
Right.
use those funds to generate some sort of cash, which is how they do it.
Right, but will not have infinite returns on capital because they have regulatory requirements
Yes.
of how much equity they have to have in the business. So they might have to have tangible equity. It would depend, but they have tangible equity because they do a risk-based thing instead. But let's say tangible equity, they might need to keep $1 of tangible equity for every $10 of loans and things that they had or something like that. So that would be the thing that's constraining you from having infinite returns on capital, right? An insurer might be the same way, that they have to have some amount of actual tangible equity from shareholders. They can't just use policyholder money, premiums that they generate but haven't really earned yet.
Okay. So let's talk about like over-the-counter markets, which is a stock that we do own. It's a company that we have spoken about on the podcast before.
Right.
Why do they have infinite returns on capital, and how did you decide that? How did you figure that out?
Right.
Everyone's looking for a formula. Give them a formula.
Okay, so I take out cash that they have.
Okay.
So if you take their assets, which you'll see listed in places, they're like return on assets and stuff, it's calculating it using cash probably. You take out all that cash and you notice that they actually don't have, what you'll notice is actually, if you compare like cash to retained earnings, for instance, you'll notice that this business actually isn't retaining earnings except to the extent it's just leaving cash on its balance sheet. Now, an argument can be made that from the company perspective, you're actually not getting infinite returns on capital because they choose to just leave that cash on the balance sheet instead of buy back the stock, pay dividends, things like that immediately. Still, the way that I care about it, always I talk about, is the reason why I care about infinite returns on capital is because I'm thinking in terms of how much growth costs. And I think that over-the-counter markets can grow 10% next year. They don't need to actually retain any shareholder money to do that. A bank does.
Yeah.
A bank does because it needs to have a larger equity base to be able to have a larger balance sheet next year.
So over-the-counter markets, for example, they could use all of their, earnings to either pay back or buy back their stock or pay it out as a dividend, pretty much do whatever.
Yeah, and actually with over-the-counter markets, remember that the faster they grow, the higher their free cash flow conversion will be. Because actually, as they grow, they first get cash paid to them first, and then they provide services over time.
So they have a form of float.
Yes, and so the way that float works is that if you have float like that, because of you're being paid quicker than you're paying for stuff, or you're being paid quicker than you're providing services in cash terms, that means that as you grow, the faster you grow, the faster your float will grow first, and then you provide the services. So constantly you're having faster and faster growth, then you'd be having more and more float. But the reverse is also true, which is if you start to shrink, like an insurer starts to run off their business, then of course your float goes down over time.
Sure.
But if I'm expecting over-the-counter markets to grow somewhat next year in terms of revenues and things, then I'm expecting upfront payments to grow. So I'm expecting them to be financed entirely by customers, not needing shareholders to put money in.
So let's talk about float as well, because I guess a lot of companies that have these infinite returns on capital, they have float.
They have.
So I think a good example of float is Points International. So
All right.
maybe explain that, how that like payable cycle works. So
Sure.
people
So
could
Points
understand
International is a good example. It reminded me a lot of like an ad agency or something. So Points International, when I was reading about the company, something that was confusing me is that people kept saying that the company buys airline points, airline miles, and then it sells them. So it buys from airlines and then it sells them to individuals who want to fly on the airline, who are members of their frequent flyer program. And that didn't make sense to me because when I looked at the balance sheet, I wasn't seeing airline miles listed there. There is a small amount of airline miles that show up, but why is that happening? Well, then when I read the regulatory filing, I realized, they don't go long airline miles. They don't buy airline miles and then sell them. What they do is they simultaneously buy them and sell them. So,
Like as an as-needed thing?
Yeah. So, but on a cash basis, actually what's happening is that they're getting paid by, so you buy airline miles from them. You pay them long before they pay the airlines, because they have a note in there saying that they pay the airlines on average 30 days after the end of the month. Well, if you assume that, you know, this program that they're running, this marketing thing, is happening as an equal chance of selling miles on any day of the month, then that means on average it'll be 15 days since they sold it that you get to the end of the month, and then they have another 30 days after that where they actually have to pay the airlines. So you got 45 days on average before you're paying the airlines, and yet you have 2 days of you're getting paid your cash. So actually, the more and more they're selling, the more and more cash they're generating, right? Which is the opposite of if they did it the other way, which is how I thought it worked when I read what other people were saying. Other people were saying it as if they were a retailer of airline miles, but that would mean that they buy them, keep them in inventory, and then sell them, which is how retailers work. And it's completely opposite. They don't have float, instead they have a big inventory item. So when you see there's no inventory, you realize, oh, this is how they're generating float. Instead, it completely changes the economics of the business. Yeah. Because if you had a lot of inventory, you'd have to have very high returns. You'd have to have big markups. But if you have no inventory, then it completely changes it. You know, it's like with jewelers. There was a company, Blue Nile. It's not public anymore, but it was able to have much lower margins and price things much lower, because it wasn't actually paying for its inventory before it was selling it to you. And by doing that, having float all the time, it was able to way underprice other kinds of jewelers who would actually have to own it for a while. So it's just a better business that way.
Got it. So companies that have infinite returns on capital, they all have a source of float. And then it's good to understand that source of float, because that could serve as a competitive advantage or just like the quality of a good business. Yeah,
and the thing to understand about float is it has to be a timing issue. That's the thing that I think.
Well, it's kind of like Amazon.
Right. Okay. So Amazon's a really good example, because Amazon is able to have basically negative working capital in their retailing business, but I wrote up some things about MROs, which are like companies like Ranger and stuff, which compete with Amazon. And one thing people ask a lot about is like businesses buying from Amazon. But one thing you have to be careful about with that is if Amazon is supplying businesses on the same terms as those kinds of companies do, they expect to be extended credit.
Yeah.
And so you can't have the economics work the same way, because that means that Amazon would then actually have to own inventory outright and wouldn't be able to be operating without needing working capital. So then it changes some things about how you have to price things and all that. It's just a different business. Selling to customers, you can expect the customers to pay you in cash quickly, which is how it works with Points International. And then selling to businesses, it's going to be the reverse of that. Businesses expect to be extended credit. And so that's why it works for Points International. They have a partner in airlines who are willing to extend them credit, and then they can demand that they not have to extend credit to customers, because customers, individuals, are used to paying for things right away using their credit cards.
Yeah, so there you go, infinite returns on capital and float with a couple different ideas. We are coming up on our 10 minutes here soon. Check out all of our work, Focus Compounding Podcast, 147 plus different podcasts on everything investment related. That's got to be a ton of hours of, it's got to be over 100 hours of podcasts that we have pumped out over the past 2 years. Check out our YouTube, where we have a lot of stuff on there as well. Subscribe, thumbs that up, and follow us on Instagram. We are going to be doing a lot of stuff on here. I said in every single video, but we are. So make sure you hit that follow button. We will see you in the next, not podcast, not video, Instagram, IGTV video.